Hello everybody, welcome to the ActivTrades Weekly, where every Friday we look at the events dominating the news agenda. We focus on geopolitics, economics, keep an eye on how the markets are doing, and always look for trading ideas. This week, the Fed and the Bank of England monetary committees decided on interest rates. These decisions and the statements that normally follow them were awaited with impatience by investors that were expecting clues on what are the prevailing sentiments among central bankers. The Federal Reserve's FOMC reiterated its intention to keep rates close to zero until at least 2024. Despite taking into account the massive $1.9 trillion stimulus package that was signed last week by President Joe Biden and the success of the vaccination program, which both combined are likely to trigger an economic boom in the country. Upgrades to growth forecasts were significant, jumping from the 4.2% in December to the 6.5% we have now. This will be the fastest economic expansion since 1984 and one likely to drive inflation to levels above the 2% target. This resulted in an acceleration of the recent bond sell-off, pushing the yield of the 10-year Treasury above 1.7% for the first time since January 2020, as investors started to price in the prospect of higher inflation and the possibility of an earlier than expected tapering by the Fed. Meanwhile, on the other side of the Atlantic, Bank of England officials also met. As expected, the Monetary Policy Committee acknowledged the improvements in outlook for the country's economy, as well as highlighting the rising currency and costs of government borrowing. The minutes of the meeting reiterated the bank's commitment to the current monetary policy, and while acknowledging that there is now a stronger outlook in terms of consumption growth, no hints were provided of any desire to intervene and control the sell-off in the bond market. Free from the political uncertainty of Brexit and with a successful vaccination program, the UK's economic prospects improved considerably and a large expansion is expected. And this is why the yield on the 10-year gilts has doubled comparatively to where it was only a month ago. Considering the current scenario, it comes as no surprise that the dollar and the pound both had a good week, gaining ground versus other major currencies, as both the US and the UK appear to be in pole position for the post-pandemic economic recovery. On the losing side, we find the euro, suffering as investors see the shambolic vaccine rollout across the continent as a downside risk for the currency. Also on a losing streak is gold. The precious metal has been under pressure from a rising dollar and, at least for the moment, seems unable to rise above the 1750 resistance. Now, talking about next week. Over the next 7 days, we can look forward to the release of important economic data that is likely to impact the markets. I would highlight the PMI numbers for Europe, UK inflation, and the release of the Bank of Japan monetary policy meeting minutes as potential market drivers. And this will be all for today. I will be back next week with more views on current affairs and the financial markets. In the meantime, you can go to ActivTrades.com for more market analysis. If you enjoyed the video, click the like button and subscribe to our channel. Thank you very much for watching.